trillion-dollar shadow bank just hit crisis mode, signaling a systemic failure in the financial plumbing that most investors are completely ignoring.
It's the ultimate red flag. Macro experts George Gammon, bond king Jeffrey Gundlach, and Eurodollar specialist Jeff Snyder are sounding the alarm on a $52 trillion private credit time bomb that's finally starting to explode.
We've used advanced AI to strip away the fluff and condense hours of their high-level macro analysis into just minutes of pure, actionable alpha.
You'll discover why the housing market is seeing its biggest discounts since 2008, and the exact level Gary Wagner says gold must hold to survive this sea-wave correction.
George Gammon is sounding the alarm on a trillion-dollar shadow bank crisis that most people aren't even tracking. The Federal Home Loan Bank, or FHLB, has seen its lending explode to $1.1 trillion.
That is the alpha here. When the FHLB becomes the primary source of cash, it means the private market has stopped lending. It's the ultimate red flag for the financial plumbing.
Wait, 1.1 trillion. And what exactly is an FHLB? It sounds like a government office that handles mortgages.
It used to be, but George Gammon points out it's morphed into a lender of last resort for banks that can't get money anywhere else.
Exactly. While this suggests a massive crisis is brewing, there's another hidden risk in the repo market we'll uncover in a moment.
George Gammon's core thesis is that the FHLB is now acting as a backdoor bailout mechanism because the actual repo market is broken.
Right. Advances surged 28% recently. Banks are bypassing the Fed's discount window because it looks bad and going to the FHLB instead.
So it's like a secret credit card for banks when their main ones get declined.
Pretty much. But the problem is this credit card is funded by the taxpayer and the systemic risk is just being moved around, not fixed.
George argues that this is essentially a shadow version of 2008.
Great. So the plumbing is leaking again, and we're just putting a bucket under it.
George Gammon highlights a huge issue with collateral. Banks are paying as much as 5.4% for overnight cash because they don't have enough pristine collateral like treasuries.
If you don't have the collateral, you can't borrow. It's why we're seeing this massive shift to the FHLB.
Wait, let me get this straight. Banks have the money, but they don't have the receipts to prove they can borrow more.
Exactly, the high-quality collateral is being hoarded. When that happens, the system seizes up.
It's like a bar where everyone has cash, but the bartender only accepts gold coins.
And the FHLB is the guy in the corner selling gold coins at a massive markup.
We also need to look at the scale. George mentions that shadow banks now hold over $63 trillion in assets.
That's nearly half of the global financial system. These aren't just small players. They are the market.
63 trillion? That's a lot of zeros. Are these shadow banks regulated like regular banks?
Nope, that's the shadow part. Less regulation means higher risk and more leverage.
So if one of these $63 trillion dominoes falls, it takes the whole table with it.
Honestly, at this point, I'm surprised the table is still standing.
George Gammon also points to the $2.7 trillion in commercial real estate loans held by smaller banks.
When those buildings lose value, the bank's collateral vanishes. It's a feedback loop of defaults.
So empty office buildings are actually making the banking crisis worse.
Yes, if the bank's assets are worth less, they can't borrow in the repo market, forcing them back to the FHLB.
And eventually, the FHLB can't handle the load anymore.
So we're watching a slow-motion car crash in the real estate market.
What's the timeline? George Gammon predicts a systemic accident or liquidity event within the next 12 months.
His reasoning is simple. The FHLB can't keep expanding forever. Once they hit their limit, the banks have nowhere else to turn.
So what does an accident look like? Is my ATM going to stop working?
Likely more like a sudden spike in interest rates or a major hedge fund imploding overnight.
It's a broken wing scenario where the system can't fly anymore.
Well, that's a terrifying metaphor to start my day with.
George also predicts the Fed will have to step in with at least $500 billion in emergency liquidity.
They'll call it temporary, but as George points out, these interventions usually become permanent fixtures of the system.
500 billion? Where do they even get that money?
They print it, which just kicks the inflation can down the road.
So the solution to the debt crisis is more debt, bold strategy.
It's worked 0 times in history, but hey, maybe this time is different.
So how do we watch this play out? George Gammon suggests monitoring the SOFR, the Secured Overnight Financing Rate.
If SOFR spikes above 5.5%, it means the plumbing is officially clogged. That's your signal to get defensive.
SOFR, got it. So if that number goes up, I should probably look at my portfolio.
Exactly. It's the pulse of the entire global financial system.
George also recommends tracking FHLB debt issuance. When it rises, it means banks are getting desperate.
The more they borrow from the FHLB, the closer we are to that breaking point.
So high FHLB borrowing equals high anxiety for the rest of us.
That's the George Gammon playbook. Watch the plumbing, because the sink is about to overflow.
Better, go find my metaphorical galoshes then.
We're dissecting the latest pre-market chaos from Matt DeWolf at Trade Brigade, and the headline is simple. The crash is accelerating.
Matt is highlighting a massive gap down this morning, with indices flushing through levels that were supposed to be the floor.
Wait, flushing through the floor. Does that mean my retirement account is officially in the basement now?
It means the momentum is heavily bearish. Matt DeWolf points out that when we gap down like this, the first 15 to 30 minutes are pure survival mode.
According to Matt, this isn't just a small dip. We're seeing serious institutional selling pressure.
Exactly. He notes that the VIX is spiking, which usually means the fear index is off the charts.
So the VIX is basically the market's panic button.
Pretty much. And Matt DeWolf is saying that button is being smashed right now. Matt DeWolf's core thesis is that the trend has shifted from buy the dip to sell the rip as we break long-term supports.
He's looking at the moving averages, and they are sloping downward like a black diamond ski run.
Hold on. If they're sloping down, doesn't that just mean things are on sale?
Matt would argue it's only a sale if people actually want to buy. Right now, everyone is heading for the exits.
And the volume confirms it. Matt DeWolf highlights that the selling isn't just retail panic, it's big money moving out.
So if the big guys are leaving, I should probably put my sneakers on too.
Matt DeWolf is closely watching the SPY, noting it's gapping down toward that psychological 3,900 mark.
If that level fails to hold, Matt warns there's a vacuum of support below it.
A vacuum? Like it just drops with nothing to catch it?
In technical terms, yes. Matt sees very few buyers stepping in until we hit much lower valuations.
The tech-heavy NASDAQ or QQQ is looking even worse in Matt's analysis.
He mentions that the big tech names are finally losing their grip on the market's crown.
Wait, even the giant tech companies are falling. I thought they were invincible.
Nobody is invincible in this tape. Matt DeWolf points out that QQQ is leading the downside momentum today.
When the leaders fall, the rest of the market usually follows them down the stairs.
Great. So the cool kids are failing the test and taking us with them.
Matt DeWolf highlighted the VIX jumping above 25. That's a major red flag for volatility.
When the VIX is this high, option premiums explode and trading gets incredibly choppy.
Is 25 a really big number for this fear thingy?
It's significant. Matt notes that anything over 25 usually coincides with forced liquidations.
Basically, it's the market's way of saying brace for impact.
Understood. Bracing now.
What's the endgame here, according to Matt DeWolf?
He's predicting a potential flush all the way down to 3,850 if we don't see a bounce soon.
Another 50 points down? That sounds painful.
Painful for bulls, yes. Matt believes the market needs to wash out the weak hands before a real bottom can form.
Could we see a miracle bounce today?
Matt DeWolf is skeptical. He says unless we see a massive volume spike on the buy side, any rally will just be a dead cat bounce.
A dead cat bounce? That's kind of dark.
It's a trading term. It means even a dead cat will bounce if you drop it from high enough, but it's still not coming back to life.
Exactly. Matt is looking for sustained buying, not just a temporary reprieve.
Okay, so no miracles yet. Got it.
So what's the play? Matt DeWolf suggests sitting on your hands for the first 15 minutes.
Right. Let the opening range settle before you try to pick a direction. Trying to trade the open in this environment is like catching falling knives.
I like my fingers, so I'll definitely wait for the settling thing.
Smart move. Matt emphasizes that preservation of capital is priority number one right now.
Matt also says to keep a close eye on the VIX. If it stays elevated, the volatility isn't over.
And look for capitulation volume. We want to see a massive spike that suggests everyone has finally given up.
So we're waiting for everyone to give up so we can, start over?
That's often when the best opportunities arise, according to Matt DeWolf's analysis.
Understood. I'll be over here, watching the VIX and keeping my hands in my pockets.
The gold market just got a reality check. According to Gary Wagner, gold has officially broken through major support levels, signaling a deeper correction.
Exactly. Gary is mapping out what he calls the final C-wave correction, and it looks like we could see prices heading toward $2,550.
Wait, C-wave? That sounds like something from a surf movie. Are we talking about a wipeout for gold investors?
Not a wipeout, but a technical reset. It's part of the Elliott wave theory Gary uses to track market cycles.
So while gold is taking a hit now, Gary's analysis suggests this might be the final leg of the drop before a potential rebound.
Okay, so it's like the dark before the dawn. I can handle that, as long as the dawn actually shows up.
Gary Wagner's core thesis is that gold is currently trapped in a three-wave corrective pattern. We've finished waves A and B, and now we're in the thick of wave C.
Right? And wave C is usually the most aggressive. Gary is eyeing that $2,550 mark as a potential bottom.
Hold on. If it hits 2,550, that's a pretty big slide from the highs. Why is this happening now?
It's a mix of a strengthening dollar and the market adjusting to the Fed's stance on interest rates. Gary notes the technicals are just reflecting that pressure.
So the C wave is basically the market blowing off steam after that massive rally we saw earlier this year.
So gold is just taking a very expensive nap.
Gary Wagner points out that the US dollar has been on a tear, which is bad news for gold since they usually trade inversely.
Exactly. When the dollar index or the DXY goes up, it makes gold more expensive for international buyers, dampening demand.
Wait, so the dollar getting stronger is actually hurting my gold stash? That feels like a lose-lose.
It's the classic safe haven tug of war. Right now, the market is choosing the greenback over the yellow metal.
And Gary's charts show that until the dollar cools off, gold's path of least resistance is firmly down.
Great, so I need the dollar to chill out so gold can shine again.
Gary notes that gold didn't just slip, it crashed through $2,600 and $2,580 support zones.
Those were psychological floors. Once they broke, Gary says it opened the door for technical selling.
Psychological flaws? You mean the traders just got scared?
Sort of. It triggers automated sell orders. It's like a domino effect once those numbers are hit.
And without a quick recovery back above 2,600, Gary believes the bear momentum stays in control.
So the robots are selling my gold? That's just rude.
Gary Wagner also highlighted how the Federal Reserve's higher for longer rhetoric is weighing on the non-yielding metal.
Right? If you can get 5% yield on a treasury bond, gold's 0% yield looks a lot less attractive.
So people are ditching gold because they want those interest payments.
In a nutshell, yes. Opportunity cost is a huge factor in Gary's model right now.
Until the Fed clearly signals a pivot to lower rates, Gary expects gold to struggle against that yield pressure.
Sounds like the Fed is gold's biggest frenemy right now.
So where does this end? Gary Wagner is predicting a bottom somewhere between $2,530 and $2,550.
That's his buy zone. He expects that's where the technical correction will finally run out of steam.
2,530. That's quite a bit lower. Should I be worried or excited?
Gary sees it as a healthy correction in a long-term bull market. It's essentially a chance to load up at better prices.
If it holds there, it sets up a much stronger base for the next leg up in 2025.
Okay, so I just need to survive the dip to get to the trip. Got it.
Despite the short-term pain, Gary isn't a gold bear. He expects a massive recovery once this C wave is mapped out.
Exactly. Once the technicals are cleared, he's looking at new all-time highs as the global economic uncertainty persists.
So we're just in a temporary detour on the way to the moon.
You could say that. Gary emphasizes that the fundamental reasons for owning gold, like debt and inflation, haven't gone away.
So for Gary, this is a when not if scenario for a gold comeback.
I like the sound of all-time highs way better than C waves.
Gary Wagner's top advice? Keep a very close eye on the dollar index. If it starts to peak, that's your signal that gold is ready to turn.
And don't catch a falling knife. Wait for those support levels at 2,550 to prove they can hold.
Wait, falling knife? That sounds dangerous. Can I just use a spatula instead?
It means don't buy while the price is still crashing. Wait for the market to stabilize, just like Gary's charts suggest.
Finally, Gary suggests looking for a reversal candle, a sign that buyers are stepping back in near his target levels.
Technical analysis is about patience. Gary isn't rushing in, he's waiting for the data to confirm the bottom.
So watch the dollar, wait for the bottom, and don't panic. Easy, right?
Easier said than done when you're watching the screen. But that's why we follow Gary's mapping.
Fair enough. I'll just keep my spatula ready for when the knife stops falling.
Nick Gurley is sounding the alarm. New home sales are hitting a wall, and builders are slashing prices at a rate we haven't seen since the 2008 crash.
It's a massive shift. Nick points out that the months of supply for new homes has spiked to over 9 months in some regions, which is deep into recession territory.
Wait, 2008? Are we talking about another total meltdown where houses lose half their value?
Nick isn't saying it's a carbon copy, but the inventory data he's tracking is definitely flashing red.
The single most important insight from Nick Gurley right now is that builders are sitting on way too much stock. They're forced to offer massive discounts to keep the lights on.
And while these new homes are on sale, existing homes are still stuck in a supply desert. We'll get into that weird two-tier trap in a minute.
So if I'm looking for a house, the new ones are cheaper but the old ones aren't. That's confusing.
Exactly. Nick's analysis shows the market is effectively splitting in half, and builders are the ones blinking first.
Nick Gurley highlights a staggering stat. We are looking at 9.3 months of new home supply on the market.
For context, a healthy market is usually around 6 months. Anything over 9 is what Nick calls the danger zone for price stability.
Hold on, what does months of supply even mean for a normal person?
It means if builders stopped building today, it would take over 9 months to sell everything they've already got.
And when that number gets this high, builders start panicking and cutting prices just to move the units.
So it's basically a clearance sale at the construction site.
According to Nick Gurley, builders are getting sneaky. Instead of just dropping the sticker price, they're spending billions on mortgage rate buy-downs.
Right, they'll offer a 4 or 5% rate when the market is at 7, just to make the monthly payment look affordable.
Wait, is that a bad thing? Low rates sound great to me.
It's great until the builder can't afford to subsidize those rates anymore. Nick's data suggests those incentives are effectively a hidden 10 to 15% price cut.
So the value of the house is already lower than what's on the contract. The builder is just subsidizing the difference.
So it's like a buy now, cry later situation for the builder's profit margins.
Nick notes that the pain isn't distributed equally. Florida and Texas are getting hit the hardest because that's where all the building happened.
Inventory in places like Southwest Florida has doubled in a year. Nick calls it the epicenter of the current correction.
I thought everyone was moving to Florida. Did they all just change their minds?
Migration is slowing down, but builders kept building like the party would never end. Now they're stuck with too many houses and not enough buyers.
And as Nick points out, when the Sunbelt sneezes, the rest of the housing market usually catches a cold.
Note to self, maybe wait a bit longer before buying that Florida condo.
Nick emphasizes that builders have had record profits lately, but that's ending. Their costs are up, and they're forced to discount.
Lennar and D.R. Horton are seeing their margins shrink as they try to compete with a slowing market.
Should I feel bad for the billion-dollar building companies?
Probably not, but Nick warns that when their margins hit zero, they stop building entirely, which can lead to job losses.
It's a cycle. High prices lead to overbuilding, which leads to discounts, which leads to a construction halt.
And Nick thinks we're right in the middle of the discounts phase.
Based on Nick Gurley's trajectory, we could see another 10 to 15% drop in new home prices before things stabilize.
He argues that as long as inventory stays near 9 months, the downward pressure on prices is relentless.
Is there any scenario where prices go up instead?
Only if the Fed slashes interest rates to zero tomorrow, which Nick doesn't see happening.
So we're looking at a slow grind down rather than a vertical cliff.
A slow grind still sounds pretty painful for homeowners.
Nick's second big prediction is that the lock-in effect will keep existing home sales low, but eventually the new home discounts will pull the whole market down.
If a brand new house next door is 20% cheaper, you can't exactly list your 30-year-old house for a premium.
So the new homes are basically the anchor dragging the rest of the market down.
That's exactly it. Nick believes the new home market is the leading indicator and the rest of the market is just lagging behind.
It's like watching a slow-motion train wreck. You know where it's going. It just takes time to get there.
Great. Another reason to keep renting for a while.
Nick suggests everyone watch the months of supply in their specific zip code. That's your early warning system.
If it climbs above 7 or 8 months, you know price cuts are coming.
Where do I even find that info? Is there an app for that?
Nick uses data from sources like Reventure app or local MLS reports. It's public info if you know where to look.
Nick's final advice? Look past the free kitchen upgrades and rate buy-downs. Calculate the actual cost per square foot.
So, basically, don't let a shiny new fridge distract me from a bad deal.
Precisely. As Nick Gurley showed, the builders are desperate to move these homes. Make sure you're getting the best price, not just the best gimmick.
The leverage is shifting to the buyer for the first time in years. Use it.
Today we're dissecting a massive warning from Jeff Snyder about what he calls a $52 trillion private credit time bomb that's finally starting to explode.
Jeff's analysis is chilling because this isn't the regular banking system we can see. It's the shadow banking world where transparency goes to die.
Wait, 52 trillion? That is more than double the entire US GDP. Are we saying the economy is built on a pile of hidden IOUs?
According to Jeff Snyder, yes. And while these funds claim to be safe, the data shows the cracks are widening.
The real insight here is that these losses aren't showing up in official stats yet because the system is designed to delay the pain.
Right. And while everyone thinks the dry powder will save us, Jeff explains why that's a total myth, which we'll get into in just a second.
Wait, so I'm supposed to believe $52 trillion is just hanging out in the dark?
It's not just hanging out, it's leverage on top of leverage, and Jeff argues the leverage is starting to snap.
Jeff Snyder's core thesis is that after 2008, banks didn't stop making risky loans. They just moved them into private credit funds.
Exactly. It's regulatory arbitrage. If the bank doesn't hold the loan, they don't have to hold the capital against it.
So it's like moving your messy laundry into the closet before guests arrive. The mess is still there, you just can't see it.
That's a perfect analogy, except this closet is worth $52 trillion, and the door is starting to buckle.
And Jeff notes that because these aren't banks, there's no lender of last resort when things go south. Jeff Snyder highlights a dangerous trend called PIKE, payment in kind. Instead of paying interest in cash, companies are just adding it to their debt balance.
It's basically pay me later on a corporate scale. it keeps the loan from technically defaulting, which keeps the fund's returns looking stable.
Hold on. So, if I can't pay my credit card, I just tell the bank, add it to the tab, and they say my credit is still great.
For you, no. For a billion-dollar company and a private credit fund, apparently yes.
Jeff argues this is just masking a massive wave of insolvency that's already here. Many analysts point to dry powder as a safety net, but Jeff Snyder says that's a misunderstanding of how these funds work.
Right? That money isn't sitting in a vault. It's a promise from pension funds and endowments to provide cash when called.
So if the market crashes, these pension funds might just not have the cash.
Precisely. Jeff calls it a liquidity illusion. When the call comes, the money might be nowhere to be found.
And when the dry powder evaporates, the whole $52 trillion structure starts to lean.
Jeff also points out that the illiquidity premium, the extra return you get for locking your money up, has basically disappeared.
Exactly. So much capital has flooded into private credit that funds are competing by accepting lower rates and weaker protections.
So investors are taking on bank-level risks for less than bank-level clarity.
That is the paradox. They are being paid less to take on more hidden risk. Jeff Snyder predicts a massive wave of defaults as these companies can no longer afford 10 to 12% interest rates.
Most of these loans are floating rate. When the Fed hiked, these companies' interest expenses doubled or tripled overnight.
Ouch. So even healthy companies are basically being choked out by their own debt.
Exactly. Jeff believes the zombie company era is finally reaching its dead end.
He expects we'll see the first major fund gates where they stop people from withdrawing money within the next 12 months. Jeff also warns that if one fund fails, they'll all start selling liquid assets to cover their hides.
That means selling stocks and bonds into a falling market, which turns a private credit problem into a global market problem.
So my 401k could get hit because some shadow bank's closet door finally burst open.
That's exactly the contagion risk Jeff is highlighting. It's all connected.
The $52 trillion question is, who blinks first?
Jeff suggests watching BDCs, business development companies like ticker ARCC or BAP.
If those start trading at a massive discount to their net asset value, it's a sign the market doesn't trust the loan books.
Got it. So if the tickers go red, the shadow bank bomb is ticking faster?
Precisely. It's the closest thing we have to a real-time warning light for Jeff Snyder's thesis. Jeff also points to high-yield spreads. If they blow past 5%, the panic is officially starting.
Keep your eyes on the data, because as Jeff Snyder says, the official narrative won't tell you the truth until it's too late.
Well, I'm definitely going to be checking those spreads tonight. This was a wake-up call.
Better to wake up now than when the bomb actually goes off. Jeffrey Gundlach just sat down with Julia LaRoche and dropped a massive warning. He calls private credit an unmitigated disaster waiting to happen.
He's not pulling punches. Gundlach argues that the lack of transparency in this $3 trillion market is masking huge risks as interest rates stay elevated.
Hold on, $3 trillion. Is that like the mortgage crisis all over again? Or am I overreacting?
Gundlach thinks it might be worse because these aren't public trades. They're private deals where nobody knows the real value until the floor drops out.
And while everyone's distracted by the S&P 500, Gundlach is looking at the plumbing of the financial system, where the leaks are starting.
Great. So the Bond King is basically saying the basement is flooded and we're just now noticing?
The core of Jeffrey Gundlach's thesis is that private credit has grown too fast, ballooning to over $1.7 trillion.
Exactly. During his talk with Julia LaRoche, he pointed out that these loans are floating rate, meaning as the Fed hiked to 5.5%, the cost for these companies exploded.
Wait, so if the rates go up, the companies borrowing the money just have to pay more instantly?
Exactly. And unlike public bonds, there's no market price. It's just whatever the lender says it's worth on their books.
Which Gundlach calls mark-to-make-believe accounting.
Mark to make believe? That sounds like something I do with my bank account when I'm broke.
Gundlach notes that the Fed's target of 5.25 to 5.5% is finally biting, but there's a huge lag effect.
He told Julia LaRoche that it takes 12 to 24 months for these hikes to really crush consumer spending and corporate profits.
So we're just now feeling the pain from hikes that happened a year ago.
Precisely. It's like a delayed hangover. You feel fine while you're drinking, but the next morning is a disaster.
And Gundlach thinks the morning is just beginning for small-cap companies and highly leveraged borrowers.
So basically, the party's over, and we're just waiting for the headache to kick in.
Then there's the elephant in the room. $34 trillion in national debt.
Gundlach is incredibly bearish on the deficit. He explained to Julia that as old debt matures, it's being refinanced at these much higher rates.
Wait, 34 trillion? How do we even pay the interest on that?
That's the point. Interest payments are now topping $1 trillion a year. That's more than we spend on the entire military budget.
He calls it a fiscal suicide mission. If rates don't come down fast, the interest consumes the entire budget.
So the government is basically using one credit card to pay the interest on another credit card.
Gundlach also touched on the carnage in commercial real estate, specifically office buildings.
He's seeing valuations drop 20 to 40% in major hubs. When those loans come due, the banks are going to have to seize buildings that aren't worth the debt.
40%? My house better not do that.
It's different for residential, but for offices? Gundlach thinks many of these prime buildings are becoming zombie assets.
And if the banks are stuck with zombie buildings, they stop lending to everyone else. That's a classic credit crunch.
Great. So banks get stuck with empty offices, and I can't get a car loan. Everyone wins.
Gundlach isn't buying the soft landing narrative. He expects a hard landing as unemployment ticks above 4%.
He pointed out to Julia LaRoche that once the unemployment rate starts rising, it doesn't just stop. It tends to cascade.
Why does it cascade? Doesn't the Fed just lower rates to fix it?
They try, but Gundlach argues that by the time they cut, the momentum of layoffs is already too strong to stop.
So by the time we feel the help from the Fed, the economy is already in the dirt.
So it's like trying to put out a forest fire with a garden hose after the wind starts blowing.
On a more tactical note, Gundlach is bullish on gold as a hedge against this fiscal mess.
He thinks as the world watches the U.S. struggle with its debt, the dollar's status as the sole reserve currency will continue to erode.
So if the dollar goes down, my shiny gold coins go up?
Essentially, he sees gold as the ultimate insurance policy when the people running the currency seem to have lost the plot.
He's looking for gold to break out to significantly higher levels if the recession hits and the Fed starts printing again.
Maybe I should start looking for buried treasure then.
Jeffrey Gundlach's final takeaway is simple. Get liquid and stay away from the unmitigated disaster of private credit.
He suggests focusing on high-quality bonds and keeping cash ready for when assets finally go on sale.
So basically, don't be the person holding the mark-to-make-believe loans when the music stops.
Exactly. Cash might be trash when inflation is high, but it's king when everything else is crashing.
Keep a close eye on the yield curve and unemployment stats. Those are Gundlach's two biggest indicators right now.
Yield curves and gold. Got it. I'm gonna go check my couch for change now.
So let's kick things off with Jeffrey Gundlach. His main thesis? The private credit market is like a ticking time bomb.
Absolutely, he's highlighting how systemic risks are accumulating and could trigger a significant collapse.
So, if I'm hearing this right, he's saying we're all sitting on a financial grenade without a pin.
Yes, and the timing of that explosion is critical, as it reflects broader economic instability.
Next up, we have Jeff Snyder, who takes a different angle.
Indeed. He argues that the migration of risk into less regulated areas is what makes the current situation so precarious.
So he's basically saying the financial risks are sneaking under the rug, right?
Exactly, and that makes it even harder to predict when and where the next shock might hit.
Now, let's talk about George Gammon.
His thesis revolves around the FHLB stepping in as a crucial player during this crisis.
Wait, so he's saying the FHLB is like our financial superhero right now?
In a way, yes, but it's also concerning. This could lead to more vulnerabilities in the system.
Interestingly, all three guests converge on one key point, the instability in our financial system.
Right. They all recognize how increased private credit poses serious risks to the economy.
So no matter how they slice it, the risk is pervasive.
Exactly. Each of them highlights different risks, but the conclusion is remarkably consistent. Both Jeffrey and George stress the importance of institutional response to mitigate threats.
They believe strong interventions are necessary to prevent a wider systemic failure.
So, it's really about whether these institutions can step up when we need them most.
Exactly. A failure to act could send shockwaves across the financial markets.
An interesting point of agreement between Jeff Snyder and Jeffrey Gundlach is the need for tighter regulations.
Right, both see shadow banking as an area in dire need of oversight.
So basically, they want someone to keep an eye on the bad boys of finance.
Pretty much. They argue better regulation could minimize the risks they've discussed. Here's where it gets interesting. Gundlach believes we need immediate action, whereas Snyder thinks the risks will evolve over time.
Exactly. Gundlach sees the urgency while Snyder takes a more measured approach.
So, one's saying we need to jump in now, while the other is saying hold your horses.
Spot on. Both perspectives offer valuable insights on the timing of risks.
Now, let's dive into a disagreement between Gammon and Snyder.
Gammon views the FHLB as a stabilizing force, while Snyder remains skeptical, thinking it could lead to long-term problems.
So one sees it as a savior, and the other as a potential villain.
Exactly. It's a classic debate over intervention versus letting markets correct themselves. Finally, there's a difference in housing market outlooks. Gundlach is more pessimistic about a quick recovery than Gammon.
Right. Gundlach feels longer-term headwinds will keep pressure on housing, while Gammon is optimistic about a rebound.
Wait, so one is putting on the brakes, while the other is hitting the gas for housing?
Exactly. Their disagreement illustrates the uncertainty of market recoveries. Thanks for sticking with us. If you enjoyed comparing these expert insights, hit that like button.
And don't forget to subscribe for more bite-sized financial analyses straight to your feed.
Yeah, who wouldn't want to save hours of research while getting the best breakdowns?
Stay tuned for our next episode, where we'll help you navigate whatever is coming next in the financial world.